96% of all mutual funds fail to match the market over any 10-year period of time. I interviewed Nobel laureates. I've looked through the statistics. It's a fact.
From a financial advisor's perspective, this is absolutely correct. But it needs some clarification for those that don't understand the differences between mutual funds and index funds. A mutual fund is a vehicle that pools money from multiple investors to buy a diversified portfolio of stocks, bonds, and other securities. There are two types of mutual funds: actively managed and passively managed. An index fund is a passively managed mutual fund. When Tony Robbins is referring to the 96% of mutual funds that underperform, he is referring to actively managed mutual funds. So what he is saying effectively is to buy index funds, not actively managed mutual funds that have high management fees.
What actually is a hedge fund? I mean, we hear the term, but what is a hedge fund versus a mutual fund?
From a financial advisor's perspective, hedge funds often aim for absolute returns, meaning they try to make money as much as possible regardless of the market conditions, while mutual funds focus on relative returns, meaning they aim to perform well compared to a benchmark, like an S&P 500 index. A hedge fund can use a wide range of high-risk strategies like leverage, short selling, and derivatives, while mutual funds invest according to a prospectus that outlines its objectives, which is usually stability and long-term growth. Finally, hedge funds are private, less regulated, and often require a significant minimum investment. They're usually only available to wealthy individuals and institutions, while mutual funds are generally safer, highly regulated, and available with low minimums to the public. My favorite mutual fund companies are Vanguard, Fidelity, and Schwab. I happen to work for all three firms.
Buying an S&P 500 index fund right now is a terrible idea if you're investing any money you might be relying on anytime soon. While it is true that U.S. stocks generally go up long term, in the short run, sometimes you need to be ready for them to go down before they go up.
From a financial advisor's perspective, this cannot be more true. Before you open a Roth IRA or a brokerage account and start investing into the stock market, you need a solid financial foundation so that you can stay invested for the long term. Because if you don't and lose your job or need the money for whatever reason, you may need to sell your stocks at a loss to raise the cash that you need. So here's what I would recommend before investing. Establish an emergency fund of at least 3 to 6 months of living expenses in a high yield savings account or a money market. Pay off high interest credit card debt and make sure that you're maximizing the employer match in your 401k or...
In this video, I'm going to do a quick comparison of Fidelity's S&P 500 index fund to Schwab's S&P 500 index fund. They're essentially the same product. I slightly prefer FXAIX is because of the expense ratio, which is 0.015%, which is slightly lower than Schwab's of 0.02%.
From a financial advisor's perspective, these funds are pretty much exactly the same. So if I were you, instead of choosing based on which index saves you 10 pennies on cost, I would choose which platform you prefer the most. Because if you try to buy a Fidelity fund on Schwab's platform or vice versa, you either won't be able to do it or will pay an unnecessary transaction fee. So my advice is play around with Fidelity and Schwab's website. Fidelity is my preferred platform, but Schwab is just as good and has banking services and lending options which Fidelity doesn't have.
Is there any considerable difference between the main target retirement index funds, such as Vanguard, Fidelity, or Schwab, or is it more important to just pick one and go with it?
From a financial advisor who has worked at Vanguard, Fidelity, and Schwab, the target date index funds at the big three are really similar products. So if I were you, instead of choosing based on which target date fund is the lowest cost or highest performing, because you won't find much of a difference, I would choose which platform you like the most. In other words, compare the website, the tools, ease of business between Vanguard, Fidelity, and Schwab, because they are noticeably different. Fidelity is, in my opinion, the best all-around platform for cost, usability, and customer service, but that's just my opinion. You cannot go wrong with Vanguard or Schwab either.
If you invested $100 into Google a year ago, you'd have about $148 today. But if you invested $100 into McDonald's, you'd only have about $88. It's hard to guess whether stocks will go up or down. So what if instead of putting all your money into one company, you split it across hundreds? This is the idea behind an index fund.
From a financial advisor's perspective, there are different types of indexes: the S&P 500, the Dow Jones, and the NASDAQ, to name a few. But when most people refer to an index, they're talking about the S&P 500 because it represents about 70 to 80% of the entire US stock market, which is a good measure of how the overall US economy is doing. To compare, the Dow Jones is only made up of 30 companies, and the NASDAQ is primarily tech companies. So if you're looking for something that tracks the overall stock market, you'll want to look for one that is an S&P 500 index fund or a total market index fund, which includes the small and mid-sized companies.
Basically, all my money that's in stocks and shares is invested in index funds. Now, an index fund is something like the S&P 500, and when you invest, let's say $1,000 in the S&P 500, that basically means that your $1,000 is distributed amongst the top 500 biggest companies in the US. 2% of it would be in Apple, 2% in Facebook, 2% in Google, 2% in Microsoft. Basically, all the big US companies you've heard of, you end up investing in all of them.
From a financial advisor's perspective, I want to add a side note that most S&P 500 index funds are market cap weighted, which means that your money is not distributed evenly between the 500 companies in the S&P 500. The larger companies get more of your dollars. If we look at the Fidelity 500 index fund, you'll notice that the top 10 companies in the S&P 500 make up over 34% of the mutual fund.
And look at the impact over an investment lifetime. You really want to invest in a system. You put up 100% of the capital into the mutual fund share. Take 100% of the risk, and you get 30% of the return.
So Jack Bogle is 100% spot on when he says that 401ks are a scam.
All right, from a financial advisor who began his career at John Bogle's company, John Bogle is not talking about 401ks, nor has he ever said that 401ks are a scam. John Bogle is the founder of Vanguard, and Vanguard is the second largest 401k custodian in the US. He is credited with popularizing index funds and championed the idea that most actively managed mutual funds underperform their benchmarks over time and that high management fees will eat into investor returns, arguing that low-cost index funds were a better long-term investment for most people. That is what he's talking about, not about 401ks. And for more accurate personal finance content from a certified financial planner, subscribe.